In today's video, I'm going to be showing you how to read market structure by understanding the price action. The market is always telling us a story, and our job as traders is to understand that story through our price action concepts and make decisions and consistent decisions in high probability locations on the charts. We have a community of less than 100 traders, and we have already 25 consistently profitable traders. They all trade using these exact same concepts that you're going to learn in today's video. That is the highest volume of consistently profitable traders in any community out there. And that is because we work with our traders on a one-to-one basis once they've shown that they've already got the work ethic to be a consistently profitable trader. We all focus on one currency pair as well, and we're there in our live Discord chat every single day to talk about live price and share the trades that we're also involved in as well. That helps to accelerate your learning very quickly and also helps you to understand price delivery on a daily basis, which is the experience that you need to become consistent. So here's the concepts that we use in the markets. So just starting here on the charts, like a lot of traders are going to look at this area here as a sideways range and understand RIMC, which again is looking at sideways ranges on the left-hand side of the charts, initiations to the downside, and we're playing RIMC as continuations there. The problem with trading this sideways range here is if we just look at the highest point to the lowest point, this is the highest point, this is the current lowest point. If you're taking your RIMC here, you're selling at a low price in this A to B price range. So typically these are going to be the lowest probability sideways ranges to play as your RIMC continuations. You also need to look at the daily, right? From the day open all the way to where we are now, this is very low prices as well. So these are two factors that you can add into your system to stay out of these sorts of RIMC continuations, because typically if price has seen its move for the day and we're starting to pull back, you don't want to be selling low at the day. You only want to be looking for buy low continuations or just in general staying out of the market, because these are going to be your worst trades to take using the RIMC method. So the most recent structure break that we've seen on the chart is here, right? And when I think about structure breaks, I'm thinking about swing structure breaks. I'm not looking at these individual breaks here. These are your lower time frame structure breaks here. We don't look at those for continuations. We're looking at our A to B movement, and we're looking at the previous swing structure break in the market. A lot of traders get caught out trading these low probability continuations here at the lows of the day or the high of the day, right? If the next day opens and we see bullish continuation and then you're taking your RIMC up here, it's very high up within price. I see a lot of people on Instagram taking trades like this at very low probability locations. Now, they might work out a couple of times, but overall, these are going to be your low probability trades because you want to be buying low and selling high, not buying high and selling low, looking at continuations. So just going back into the chart now. So let's just read the current price, right? Because it's really important to understand what price is doing. We can see prices run below this low here. So we've run the liquidity, we've extended through. So if you were looking for a continuation, if this is the start of the day and we've opened up somewhere around here, this is a great buy continuation to the downside, right? But because we're such low within the day, this is a very low probability setup. So let's just play this forward. Here, we do get a reaction from the range as we always expect to, right? Ranges always give us reactions here, but again, no follow through, and we see continuation here to the upside, and then we take out the range high here. Now, what's important with reading price action is how do we run above highs and how do we run below lows? Because this gives us an understanding of what price wants to do next. Typically, if we're seeing a trending market and we're breaking above highs and we're extending through, that's going to show that price wants to continue its trend to the upside. So if this is coming from a higher time frame range, let's just say this is a sideways range initiation on the left on the higher time frame, and let's say you've zoomed in here at the point of mitigation from a previous sideways range, and you're getting your continuation structure away, right? This is exactly what we want to look for. We want to see price running above highs and extending, and it's building the picture, building a narrative and a story of what price wants to do. So because this has happened at a previous mitigation from a sideways range, and we know and anticipate the next phase of price is the continuation phase, this is good that we're seeing price breaking above highs and extending and then seeing continuations, because we want to see this sort of price delivery, because this is showing that price wants to continue in a phase of continuation in the RIMC model. Now, example here, because we've continued down, we've run below this low here, we've run above this high here, and we haven't extended, this is showing the start of a sideways ranging price action. So that's why it's important to read how we run above the highs and how we run below the lows, because then you can start to understand the sort of structure that you might get in the market, and that's going to help you to make better decisions within the market as well. We can also put this A to B tool on here so we can understand premium and discount on the charts as well. And let's just play this forward, right? And just understand exactly what price has done. So we see continuation above the high. Remember, when we're looking at these individual highs here as well, we can see price has created liquidity, but prices overall run above this high and we have not extended through the high, and we started to then move in the opposite direction. So we know now that price is creating a sideways range. So we can take the lowest point to the current highest point, and we're not going to use our premium and discount tool anymore. We're going to use our edges tool. So the highest probability locations are going to be in the bottom 25% and the top 25% here as well, depending on where price is coming from. We always have to look to the left and see, is price coming from a previous sideways range that has initiated from a good location on the higher time frame. Then when we come back here in the future and we get our reaction, which will be this reaction here, and then we're looking at good locations, seeing continuations away from this location will be a lot better to play as continuations to the upside. Don't get caught out trying to trade the middle of the range because you're too impatient to wait for the edge. These are the lowest probability locations. If you just look at every single sideways range on the chart that you've seen, and you see how many times price reacts from the 50% area versus the edges, and you can see the risk rewards are better from the edges as well, that should help you mentally see that it's better to look towards the edges and trade from the edges, and just be more patient for the edges as well. But trading continuations from the edges away from the edges are also good, right? Because if price sets up in the session and we're, let's say, down in the edge and we've come from the edge, but we're seeing continuations away, these are also okay, right? Because you're playing from the edge. It's just when price is in the 50% area of the range, these are the low probability locations. When we're bouncing from here and seeing continuations, you don't want to be getting involved in these trades. These are very low probability. So we have our area, right? If we look to the left, we can see that price is reacting from a sideways range here that initiated here to the upside as well. So we know that when price comes back into this area in the future, if we do start to slow down and move sideways, we could look for those buy low continuations inside a sideways ranging price action. Now, if price ends up seeing continuation, which we are from here, right? This high has reacted from a sideways range on the left-hand side of the charts here. And obviously we run above this high and we did an extend again, which is the sign that price doesn't want to continue. So we play that new direction here within the market. And that's how we can look to trade continuations and find the overall direction to trade in within the market. So when price does start to slow down here in the market, we can still get into these buy low continuations to the upside. But overall, we want to be looking for sell continuations here to the downside. So let's just play this forward. Here, price comes all the way back down into the edge. We get the reaction, again, from a sideways range here. Sideways range between the candles and initiation to the upside. We did get the mitigation continuation, but like I said, if price never takes out the sideways range low down here, then this can always still be played again in the future. And you don't have to trade this as a reaction in the future and guess it. You can wait for a candle reaction and then trade with a stop underneath the low of the candle. And that's a very high probability way of trading. And I'll show you in a second how I trade these sorts of setups. And now we're very clearly in a sideways ranging market, right? We are reacting from the edge and we're moving back into the middle of the range. Now, if you want to be looking for your sell setups within the market, the best sells are either going to come from the edge here, or if price runs above this high and doesn't extend, and then we see continuations back to the downside. So this is the setup, right? And the most important thing with understanding a break of structure or understanding the swing break of structure is most traders will look at this area here and say that this is their break of structure here. And now they're starting to look for any RAMC continuations or any order block continuations from this area here. This is also low probability here. The only one that we really want to focus on is the swing structure, right? Because then that's going to give us our higher time frame pullbacks and continuations. And like I said, if we're in a sideways range as well, and we run above that high and don't extend, this adds more to the picture, right? So let's play this forward so you can see it. So we get continuation here to the upside. We wrapped from the edge again, and we see a run above the high. Let's just take this back here. Now this part is very important, right? Because we run above the high and now we run into a range that's caused the swing structure break here. So let's just mark out the range. For anyone who doesn't know how to read a sideways range between the candles, I'll show you now. So if this is a candle down here, and then this is the next candle here, obviously it's going to open at the low, and we have a wick down here, and we have a wick up here. What this essentially means is price has moved down, created a low within the market. We pulled back, created a high, and then we broke the low down here. So you could see this as just a pullback, here for a continuation. But when it's between the candles like this and we get a wick to a wick before a move to the downside, this is a representation of a contained price, a sideways range, followed by an initiation there to the downside. Now, we don't have to execute this at market here to the left. What we can do is wait for price to get there in the future using the RAMC model. We see a reaction and then we trade a continuation away. So for me, I don't draw out all these areas on the charts where there's been a previous sideways range. What I do is I wait for price to get there. I wait for it to show me a setup in terms of price being in a sideways range, running above the high and not extending, reacting from a previous sideways range. Then I draw on the sideways range, and then I can start to build the narrative and the story as to what price is doing. I don't have to trade every single reaction. I wait for price to show me it wants to react. Then I apply on all of my tools, and then I can use that for direction within the market. So the difference here then between the break of structure or what most people would say a break of structure is inside the sideways range versus the one that's actually the swing structure break, these are two very different price deliveries. So even though we do have RAMC here, range, initiation, mitigation, continuation is what we could play, because this is at a low price, and this one here has caused the swing structure break, this is a lot more powerful to play. And of course we have the setup there as well. We run above the high and we don't extend. So this is the price delivery that we'd be interested in here to the downside. So when we're reading current price and we run above this high here, let's put this on, no extension, and then the next candle shows us an engulfing candle. This is my 15-minute setup here to the upside, right? A low to a high, that creates the first move. Initiation, pullback, run above that high, and then we see the bearish engulfing candle. This is my exact setup within the market to play that as a continuation there to the downside, right? With a 1 to 4 risk to reward. Now, it's the setup that's most important. Run above the high, don't extend. We react from a sideways range that causes a swing structure break. That gives us range, initiation, mitigation, continuation. So I'm always looking for my trade in that continuation phase of the RAMC model. The identification is always range and initiation on the left hand side of the charts. Then on the right hand side of the charts here is where I look for price to react. Then I draw my framework, and then I look for my setup, which is a fractal high within the market at the continuation phase, right? So anywhere within this continuation phase here to the downside, because now I have an RAMC model in play and an RAMC price delivery in play, a sell model in play. And any of the extra stuff like price running above the high and not extending here to the upside and price being in a sideways range, these are just additions to the high probability trade that I can play there to the downside. But the only thing I need to see is a swing structure break, a fractal high at a previous sideways range that is initiated to the downside. That creates a very high probability setup within the market that we can see as a continuation there to the downside. So let's just play this forward. Here to the downside, again, that will be break even and eventually obviously hit TP. So that's a great trade to get involved in overall. Now we can see that prices run this low down here. So this is the low or a swing low within the market. So all I want to understand now after this has continued is how do we break below this low? So because we broke above this high, we didn't extend. We broke below this low and we haven't extended. We're moving back into a sideways ranging market. So yes, of course, we have this A to B within here. This is a break of structure because we've broken a swing structure down here. We haven't broken one of these structures within price down here. We've broken a swing market structure, which is very important to understanding the direction within the market. Now we have our very clear A to B within the market, and because we broke through here and we didn't extend, we never ever played the 50% area. This is one of the most important things to understanding where to play your trades, and this is why the location tool is very important as well in the market. So if we just drag this across, we can just see that price is overall still sideways, right? If we were going to break out to the downside, this breakout here would have extended and just continued there to the downside. Then we can look more towards the 50% for continuations. But because we broke through the structure low here, this is where we don't play the 50% because price is still showing us that it's ranging. So the only location that we want to play sells from is that top 25% in the market there. Now we also have this order block at the top. We can see that price run above this high here before extending to the downside. And whenever I'm looking to play trades within the market, I want to see aggression and speed moving away from an order block because essentially that's showing the momentum that's inside the candle there to the upside. So again, you can draw this on if you want. or you can just look at the general area and wait for price to get there and then play continuations away. Either way, you can just identify on the left hand side of the chart and just wait for price to get there in the future. So there is sideways ranges here, like I said, at the 50%, but because this price action has delivered within the market, we're not looking at these areas, right? We expect price to react from here, which it is doing, but the only thing that we want to do now is either play buy continuations back to the upside into the edge, which again are lower probability and a lot more difficult to play, or we want to wait for price to get up into this edge during our session, and this is where we can look for those continuations to the downside. If we just zoom out as well and we think about where price is located, like really zoom out and understand the higher time frame, this is our A to B here, and we can see that we're overall at high prices. So if we are looking to buy any of these ranges here, we just have to understand that they are buy high continuations. These are low probability trades. Overall, we can see that prices come from a sideways range to the left, and now we're reacting, and also we haven't extended through this high. So we're just reading the price action and understanding we're in bearish continuation. It's much better to trade with the trend rather than try and fight against the trend. So that helps us to understand direction. Also, things that help us to understand direction within price as well is when we break these highs and we don't extend. If we're going to see bullish continuation or some sort of bullish momentum, price would break through this high and it would want to see continuation. It's going to show us that it wants to trend in that direction by extending through the high. So these keys within price action here are really important to understand what price wants to do next. And like I said, then when we break the structure here to the downside, a lot of traders will look at this and say because it's closed below, then it's a break of structure. None of that really matters, right? The only thing that actually matters is, did we extend or did we break through and not extend? So then when we don't extend through, the only area we look for is at the edge. And if we do extend, then we can play those 50% continuations there to the downside, right? That's the only thing that matters, because price a lot of the time, even if we see this candle becomes a wick, we have to understand that wicks are closes on the lower time frame. So there's no reason to identify a break of structure as a wick or a close above or a close below. It just doesn't make any sense. The only thing that matters, like I said, is the strong rejection, and then we know that we're only looking at this location. So we know in that location, what's the only area? There isn't a sideways range up here. There's no contained sideways range. There's only a candle that's taken the liquidity before seeing the aggression and speed to the downside. So again, this is the only area on the chart on the left at the edge that we could look to play from. So let's just play this forward. Here, price is reacting from the edge, and then we start to move, price reacting from the 50%, and then we start to move here up to the edge, right? Now, this is very important to understand. The only times that we care about price delivering into this location is during the session. So you see the blue on the screen now, that's London session. The gray on the screen right now is New York session. When price is setting up in the session, this is what makes extremely high probability trades, because price moves 30 to 40 pips in New York and 20 to 30 pips during London session on average, right? Obviously, sometimes it can be more, sometimes it can be less, just depending on the volatility in the market. But if we consistently put ourselves in trades and setups where we're very likely to see 30 to 40 pip moves, and we have risk to rewards that are 30 to 40 pips, which is 1 to 4s if you're on the 15 minute, or 1 to 10s if you're on the 1 minute chart trading Chuck's setups, then we're consistently putting ourselves in the highest probability opportunities during the session on Euro USD. So this is all a part of our edge within the markets. And then, like I said, again, we just use the same understanding. We look on the left-hand side of the charts for a range or an order block that initiated, caused that swing structure break. When this is happening during the session, you're either going to trade this as a reaction. So there's many different ways that you can trade this. Put it at the 50% with your stop above the high. If you want to wait for price to react here and play a continuation, then you'll see something like this, right? You'll see a reaction, pull back, and then see continuation there to the downside. This one we can see run through. And during the session, we got another opportunity to play this to the downside, which again, run above that high and don't extend here. So on the lower time frame, you could have played continuations away. And this is the trade that Chuck's got into here to the downside with a stop above the high here with a 3.2 pip stop, which was a perfect entry at the edge. Now it's the location that he's playing based on the fact that price didn't run through and extend. So we're very likely to see a reaction here to the downside. But that was a great trade that Chucks took and got involved in using the 1 minute entries. Now, if you're not trading on the 1 minute and you prefer to wait for, let's say, more confirmation rather than just looking at location, then you could trade the 15-minute setup, right? And this is all about understanding a fractal high at a point of mitigation and then trading that as your continuation away during the session. So the fractal high was printed here, move up, pull back on the inside bar, run above that high, and then we see continuation to the downside. What fractal highs show us is sell orders coming into the market from the major players. And because this is happening at a location on the charts where we expect price to react from and see continuation, the only thing that we need to do is get the direction correct, wait for the session where we know that there's likely to be a 30 to 40 pip move, and just play alongside the direction. So I always just enter at market open here, again with a 1 to 4 risk to reward, and I've got the direction, right? The fractal high shows me a sell order coming into price where we anticipate the continuation phase. Remember, left hand side of the chart, range initiation or order block initiation. Right hand side of the chart here is where I anticipate the fractal, and I look for the fractal because then I'm always playing the continuation phase of the RIMC model, which is always the biggest move that's happening within the market. Add on the session and the timing, and we know that there's a 30 to 40 pip move happening during the session, and you've just created yourself consistent high probability opportunities within the market, trading just one pair every single day. So these are all the things that you can learn in the Trading Missing Pieces course. Of course, it's really important to understand the actual price action and reading the price action moving into these locations so that you can understand this model and you can understand how to trade this model effectively and know where to look and where your eyes can look. And if you're not understood on the Trading Missing Pieces course, all it is reading price action. So we teach you multiple different ways to read price action, run above highs, run below lows, what price does next, and then have a process on how to read those. And then also put your eyes into the highest probability locations on the chart, right? And stay away from the lowest probability locations. So like I said, when we're in a sideways range, the lowest probability locations on the chart are going to be the 50% area. So that course will teach you how to stay away from these locations and how to put your eyes into the highest probability locations on the charts, and then how to read direction within the market utilizing the RIMC model. So it's a very powerful course, probably one of the best courses that we've ever created. And then these are the continuation opportunities when you start to apply the strategies that you can look to get involved in as continuations there to the downside. Whether you want to trade the 1 minute chart or the 15-minute chart, we're always just looking for RAMC here and looking for the continuation phase to target this previous low here to the downside. The higher time frame RAMC model will give us the direction, so range and initiation, pull back into that location in the future. Like I said, this is the reaction up here from a sideways range to the left, initiation, and then we've pulled back into this location here in the future. We've run above the high and didn't extend, showing that price doesn't want to continue any lower. And now we're in that continuation phase there to the downside. And if we just think about that as our A to B premium and discount, we're selling high on the higher time frame as well, which is why these opportunities here are such high probability opportunities. And like I said, when we can read the price action here as well, and price is showing us it doesn't want to continue, and then we're trading from great locations in the session, this is how we're just repeatedly creating great opportunities to get involved in the market using the same repeatable process over and over again. If you want our free RAMC PDF with our A+ setups that you've seen in today's video, go down in the description, you can grab that for free. Also check out our website and you can see how we make traders profitable as well. Have a good day, and I will catch you on the next video.